Prompt. So good morning, all you fantastic faces out there. I think most of us are entering week 9 of working remotely from home. It's hard to believe that. But thank you for joining us this morning for Regional Economic Development Talks. We launched this series last year at the Alliance, and typically we are visiting some part of our region. And because of obvious reasons, we are working virtually, and we are pleased today to be bringing content to you. We hope that you are ready for a very fascinating and I'm sure very informative discussion with President Tom Barkin. The Federal Reserve Bank of Richmond is actually one of 12 in the regional banks in the country who's working together with the National Board of Governors to strengthen our nation's economy and communities. So pretty appropriate. We've had Tom with us before. He joined us at Lowe's during one of our investor quarterlies, and it's great to have him back here today. Tom Barkin is the President and Chief Executive Officer of the Federal Reserve Bank of Richmond. In this role, Tom is responsible for monetary policy, bank supervision, payment services, and the Fed's national IT organization. He serves on the Fed's chief monetary policy body, the Federal Open Market Committee. He's on the ground continually, except for lately, in the Fed's 5th District, which covers South Carolina, North Carolina, Virginia, DC, West Virginia, and Maryland, and has brought real focus to the less prosperous parts of our district. Tom joined the Richmond Fed in January of 2018, and before that time, he was a senior partner and chief financial officer at McKinsey & Company, a worldwide management consulting firm. He also oversaw McKinsey's offices in the southern United States. He serves on the board of directors for the Federal Reserve Bank of Atlanta from 2009 to 2014, and was the board's chairman in 2013 and 2014. He's a member of the Emory University Board of Trustees and the Greater Washington Partnership. He's a native of Tampa, Florida, and attended Harvard University, where he earned his undergraduate MBA and law degrees. Tom, welcome, and it's great to have you here today. And as folks continue piling in, I'm going to remind everybody that you are welcome to go ahead and put your questions in the chat room. We will be monitoring that, and after Tom's remarks, we can go to some Q&A. We've actually already got some coming. So Tom, I'm gonna turn the floor over to you.
Thanks, Janet, and thanks for hosting me here, and thanks everybody for your faces. I want to thank those of you, Vinay, Melissa McGuire, who've helped me out as I've been trying to understand what's happening in the economy remotely. I should also say welcome to my library at home. I'm looking forward to the chance to get out of it as soon as I can. If it's okay with you, maybe I'll just talk about 3 topics: the state of the economy, some of the efforts being made to improve it, and then finally, some of my personal reflections on the possible path forward. These are my own thoughts, not those of the FOMC or the Federal Reserve System, and that frees me up to be as direct as I want and when you ask questions. So I'm very much looking forward to hearing those at the end. But let me start with the state of the economy. The way I would describe it is where we are right now is at the end of a phase where we've been shut down and most states are on the verge of reopening. I think of it very much as the bottom of the physical economy. The data may still lag a little bit, but you know, I certainly expect and hope we're at the bottom here, but it's not a pretty bottom, as you know. The data is finally catching up with some of this reality. On Friday, we got the April unemployment numbers at 14.7%. As a reminder, our prior high post-depression was 10.8% in 1982. And the reality is actually worse than that. Another 3% unemployment equivalent have left the workforce, so they're unemployed, but they're not looking for work. And 5% more reported themselves as employed, but are actually not working. So think of it as 20% or so overall and likely to go up next month. Second quarter GDP should come in on the south side of 30%, and the global numbers should be every bit as bad. And of course, in a time where we're shut down and where personal interaction and commerce feels like you're taking a health risk, consumer spending is driving this. Consumer sentiment has plunged at an unprecedented rate. And some of the real-time indicators are shocking. TSA throughput is down 93%. Hotel revenue is down 77%. Credit card spending down 20 to 30%. And so you just hear a lot of emotion, people, especially those people who are in industries that are suffering so that the health of others won't. And so, that's where we sit today. Because this is profound, you'll see work in 3 lanes to try to bridge us to a post-COVID world. And as a reminder, the last crisis was financial, and so the Fed was the natural lead for that. This is a health crisis, so while the Fed can support it, at best we're third chair behind the public health authorities and the fiscal authorities. So let me talk about each of them and then come back to what the Fed's doing. On the public health side, this is obviously the most critical, and these widespread shutdowns have been an effort to ensure hospitals have capacity. States are very much, though, still working on landing reopening plans that limit the breadth of recurrence, especially absent a treatment or a vaccine. And so over the next month, I think in every state in our district and probably the country, you'll see folks reopening, but very critical is, what is the reopening plan? And I'll come back to that. Second is fiscal, and a reminder that the enormous amounts of money that are being thrown into fiscal these days are really stabilization rather than stimulus. It's pretty hard to stimulate spending in the current environment, but these are critical. Unemployment insurance expansion, payments to low to moderate income individuals to bridge them, small business loan program, funding to endangered industries. These are good concepts, but I will say that all these concepts were, the legislation was passed at a time where there was still a lot of hope that we were headed toward a V-shaped kind of downturn, a sharp down and a sharp up. I think this downturn is likely to last longer, though, than a couple of months, and likely to be more extended than a sharp up. So to the extent that these are a bridge to the future, we need to actually plan for what more is needed if the river that we're crossing is actually wider than we thought. And so there's been a lot done on fiscal, but I suspect more still needs to get done. And then on the monetary side, given our independence, the Fed could move the fastest. We took rates to 0 in 2 unscheduled meetings in early March. We've given strong guidance to banks that they should continue to lend to good credits in need. And I just note this is a tricky task to do well, because we also have a very much of an interest to preserving the soundness of the banks. But the banks are much stronger this time than they were in the last crisis. And we see them leaning forward to help good credits in need. We've made significant interventions to try to backstop markets. We started by ensuring that the Treasury and mortgage-backed markets continue to function. And then we reopened some 08 era facilities that support commercial paper, asset-backed securities, and money market funds. And then most recently, the CARES Act put $450 billion almost to backstop lending programs. We have launched a lending program that takes PPP paper effectively off bank balance sheets. Today, we've gone live with a program for secondary and market investment grade credits. And we've announced and are very close to launching a short-term municipal tax anticipation facility and a Main Street lending program that makes 4-year loans with first-year payments deferred to medium-sized businesses. I should emphasize, as the chair said, these are lending, not spending facilities. They're very much focused on supporting good credits through their time of need. So that's a little about what's happening. I'm sure we'll have some questions about that. And so where do we go from here? In my mind, the core challenge is getting to the other side with both a healthy population and a functioning economy. And that means we need to be working on the economy's recovery rate and also its landing point. On the recovery rate, I do believe we're going to be able to return to normal operations, though it'll be gradual. I'm really moved by the experience of China, the experience of our essential industries. They give me confidence that this is doable, so long as we have widespread adoption of some proven protocols like structural distancing and cleaning procedures and the like. But the more challenging part to me is a return to consumer confidence and spending. This has been a real shock. Obviously, if a treatment or a vaccine appears, that would be great, but if not, consumers return to the economy are going to face infection risk. And on this, I am beginning to hear stories of a dichotomy between, I'll call it the white and blue collar workforces. I think you'd see the same thing if you looked at urban workforces versus rural workforces in less affected areas. In the white-collar workforces, unemployment is up, but it's 8%. 63% can work from home. They're actually spending less on travel and dining and therefore saving more. The challenge for them is giving them the confidence to re-engage in personal commerce, given all that they're reading about the remaining risk. They need a story that'll convince them it's okay to shop or to travel or to go to a restaurant again. I'm reminded of the TSA post 9/11. It was messy for 3 months as we rolled out enhanced security and the Homeland Security Department. But 3 months later, and I traveled a lot at that time, you could convince yourself it was safe to fly. I do think this is going to be slow. And again, I look back to China, South Korea for evidence. Shopper track data would say retail traffic in those countries is still 30 or 40% down from where it was last year. So that's the white collar or the urban part of the economy. I think it might be different in some of the smaller towns, some of the blue collar workers. That their unemployment's a lot higher. It's over 20%. Only about a fifth of these jobs actually can work from home. Surprisingly, maybe their disposable income is actually projecting to be up in the second quarter, given essential worker pay in some places, enhanced unemployment benefits. Because they've been present in the workforce, I'm hearing from some lower end retailers that they actually see them engaging in commerce more freely. They don't see it as taking as much risk as maybe those who've been in shutdown. To date, their spending's actually held up, largely because they live much closer to the edge. They very much have health concerns in the workplace, and of course we've seen that in places like the meat supply chain. And if they interact more, they're going to be at greater risk of a secondary infection wave. And the dynamics between who does and doesn't engage in personal commerce and how the infection rate develops is obviously the key question for the summer and the fall. So that's the recovery rate. Let me just talk briefly about the landing spot. Think of the potential of our economy as the size of the workforce multiplied by the productivity of that workforce. And in the aftermath of this crisis, I think both of these factors face threats. It's very clear to me as I talk to our workers and others that as we've closed schools and daycares, and of course the crisis has also threatened traditional forms of elder care, that dual career couples, single parents, care providers face daunting challenges in balancing work and home responsibilities. Without more support, many risk leaving the workforce. And as I said in the unemployment thing, we did have 3% unemployment equivalent leave the workforce just last month. Perhaps vulnerable populations, baby boomers like me, will protect their health by retreating from the labor force as well. The great number of waiters and retail clerks dislocated by the pandemic may struggle to move into new careers. And pandemic control efforts are already making immigration even more difficult. We were in an environment where demographics were already shrinking our complement of workers, and I do worry that these changes could accelerate its decline. And of course, productivity could be challenged too. A new set of health and distancing protocols in restaurants, retail, and manufacturing operations are likely going to reduce throughput. Real estate assets are being stranded. Businesses are already redesigning their supply chains, which they had previously optimized on efficiency, now to refocus at least as much on resiliency. More fundamentally, increased debt loads, reduced bank lending capacity, diminished confidence has to have a meaningful impact on investment levels through which much productivity enhancement is funded. Let me close by saying it's notoriously hard to be optimistic when you're at the depths of a crisis. And of course, I described it at the beginning that right now we're at the bottom. So apologize if anything doesn't sound optimistic enough. I will say I'm a big believer in American science and its ability to create a treatment and a vaccine in time. We have weathered the hospital capacity crunch. There is a lot of fiscal and monetary support in the system. And so now, as we reopen, I'm hoping we can leverage the creative capacity of American workers and businesses to reimagine their businesses to help consumers regain their confidence while we're maintaining their health. Simple math suggests we will see a meaningful bounce in the third quarter. Our collective focus needs to be on making it a big one. Thanks, Janet, and I'm open to comments, input, and questions.
Terrific, Tom. Thank you. Always so insightful to hear from you. I'm going to go to the questions that we have in the chat room so far, and then I've got a list too of those that were kind of sent in to us in advance. This comes from Austin out there. Mr. Barkin, you've mentioned in previous talks that we're at at a sort of bottom. Can you go into detail about what that means for both the economy and the average citizen? I know you touched on this, but could you elaborate some more, please?
Yeah. Well, I mean, I think the simple way to say it is we took a step unprecedented in our history, and certainly anything I'd even thought of before, which is we mandated that whole parts of the economy would shut down. There are 30 million people who work in travel, tourism, retail, restaurant, physical retail, non-food and drug restaurants and the like, who we told to go home and not work. And then, of course, what came after that was large swaths of add-on problems. As airlines shut down, aerospace had problems. As people stopped going to car dealers, automotive manufacturing shut down. At the same time, we have $30, $25, I think today, oil, which is killing decimating the drilling and exploration sectors. You've got landlords faced with people not taking rent. I mean, this is a pretty big issue, all caused by a set of specific government actions taken to create a hospital capacity. The reason I say we're at the bottom is we're at the brink of backing off of those. Now, we'll back off of them gradually, right? I'm not suggesting there's going to be one fell swoop, and it'll differ, I'm sure, by state. But as we reopen those, I think inevitably you'll see some of those people laid off coming back to work. You'll see some of those customers told not to shop to go shop. You'll see some reemergence of the economy. And so to me, this isn't a question of, are we going to go further south? It's a question of how do we get the pace of moving up as fast as we possibly can.
Good. Okay, I'm going to go to Lawrence's question now here. Mr. Barkin, we've been hearing more about a Nike swoosh style recovery being more likely than a V or U-shaped recovery. What indicators should we be looking for to gain insight into how quickly we will be seeing the economy recover? Furthermore, what indicators should we look for to determine if the economy is still lagging?
So, one of the hardest parts of my job is that the data is late and then constantly revised. And I know you weren't here to hear me complain about the problems in my job, but that is one. And so I do think this crisis has been a great excuse to invest in more real-time indicators of what's happening. So on the labor side, I'm looking very much at initial unemployment claims. It comes out weekly. It hasn't been perfectly accurate the last 5 or 6 weeks because a lot of states have had trouble processing all the claims, but I think that'll catch up and those will come down. And you can look at initial, which I would anticipate will come down, but you can also look at continuing claims. How many people week over week are on unemployment? So I think that's a pretty good real-time indicator of the labor part of the economy. On the consumer spending part of the economy, that's harder. I gave you some of the real-time indicators that I'm able to see, on TSA throughput, and you can see, weekly what's happening to hotels. I've started monitoring credit card spend. Again, credit card spend is not a perfect indicator. It skews more toward travel and tourism. And of course, the wealthier half of the economy is more likely to use credit cards than the less wealthy, but that's another good one. Open Table, bless them, has started publishing a list of their reservations and what it's done year over year. And so I'm very much in real-time indicators wherever I can source them of the consumer side of the economy. A reminder, consumers are 2/3 of the economy. And I think they've unfortunately let us down and they will lead us back out of this. And so I'm just trying anything I can to see what the recovery rate is. And for me personally, the next 6-8 weeks will be absolutely fundamental because we are looking at what the slope of that's going to be. I mentioned Shopper Track earlier. I've got some curves from other countries. And so I'm comparing what our curve is going to look like versus what other country curves have looked like.
I'm going to skip ahead to Vinay's question because I know he's got to leave us early. Mr. Barkin, when we spoke last time, we discussed the CMBS debt. Conventional banks had been willing to work with us, the borrowers, but the CMBS special services have not been as willing. As there are hundreds of billions in CMBS debt, is there something that the Fed can do to assist even though the CMBS sits in the SEC's bucket?
We haven't found a ton to do. Vinay, thank you for your question and for your comments when we met earlier. what we have done is try to make sure that there's liquidity in those markets. And so we've opened one of our facilities up to that kind of debt. But I think what you're looking at and what a lot of hotel operators are looking at is, you know, how do I get forbearance out of a set of instruments that are sort of built not to enable even a conversation about forbearance? I mean, that's fundamentally the problem. And I don't think there's anything in particular we've got that has been helpful on that. I'm sorry about that.
All right, a question from Tim here. What is the health of hospitals in your area with a focus on COVID-19 and the lack of elective surgeries and procedures?
Yeah, so my heart goes out to the people in the hospitals, first and foremost, those people who are taking care of the sick. I'll also say, because they've been under unbelievable stress, looking at a bunch of forecasts that would have suggested that, you know, they wouldn't have enough rooms or ventilators or equipment to keep their people or their patients safe. I will say in the last 2 weeks, as I've been talking to hospitals, and I try to talk to 5 or 6 every week, I am getting the feel that the capacity crisis has been weathered, at least for now, which is great news, I think, for all of us, that we flattened the curve enough that we're not overwhelming the hospitals, at least the ones that I've talked to in our district. That has certainly come at an expense for the hospitals. And a big part of it is the postponing of elective surgery, but also outpatient contact and the ability to have someone go in an outpatient and then refer them into the hospital. And so, you know, hospital chains are facing hundreds of millions of dollars of losses. Some of the legislation has funded some amount of cash flow compensation to these hospitals. The ones I talked to would suggest not nearly enough to fill the gap. And so there's a real struggle for them. There will probably be a little bit of catch up as some of these elective surgeries come back in, but a lot of this has been lost for good, sadly. And so that's true for every hospital. I particularly then worry about the hospitals most on the edge, many of those in the rural markets. And so I do think as we look at what we need to do for the economy going forward, the plight of our hospitals is an important area of focus.
Great. This next question is from David. What's the rationale for buying bond EFTs, and what is your view of the benefits and potential problems of that program? What about the inclusion of non-investment grade debt in those purchases?
Yeah, I think you mean ETFs, but for those who don't know, the facility that goes live today, which is supported by the CARES Act and backstopped by Treasury, is intended for us to help make sure that the markets for corporate securities are functioning the way that they need to. And just a reminder that for the last 2 weeks in March in particular, they really didn't. Spreads widened significantly. Really good credits that you couldn't imagine couldn't get funding, actually couldn't get access to the markets. And so that's the intent of this facility, is to make sure that these markets function. By law, we're not allowed to take risks, take losses. We're not that kind of entity. We are allowed to help make markets work. And so, and importantly, you know, we're not in the world of trying to allocate money to this industry or this company or that industry or that company. And so together with Treasury, when we tried to structure this and we said, how do we make markets work? We focused very much on investment grade debt. And I think 75+% of this is intended to be investment grade debt, where presumably we're not taking significant risk as we make markets work. There was some concern, I think, in many places about, I'll call it the guy on the margin, the guy just left out, the guy just under investment grade. One thing that this program does is it allows you to judge investment grade as of early March. So there are some fallen angels who can also be covered by this. And then the second thing it says, we'd buy some higher yield ETFs, and there's all kinds of constraints around it. But I think the intent is a little bit of money into that market might settle that market without, in the spirit of doing ETFs, was you're not picking individual companies. You're not picking winners and losers. And you're not taking undue risk because you've got a whole range of these. And so that was the theory behind it. We'll see how that plays out.
Great, thank you. Next question is from Blaine Tollison with WSOC. For businesses looking to save money or debating a borrowing amount when getting approved for certain loan programs, how should they approach that decision?
Well, there are different programs out there with different terms and I'd say also conditions. I don't know how big your company is, but the PPP was designed for companies with less than 500 employees. It is a forgivable loan. And so if certain constraints are met, that loan balance gets forgiven. And certainly if you're in a position to meet those constraints, it's at a very attractive rate. It's an SBA guaranteed loan. That certainly would be the place I'd start. If you're not in a place to do it, then I would engage with your bank lending institution on what the right vehicle is for you. The Main Street lending program that I talked about before is a worthy thing. It has first-year payments deferred. It also comes with a set of constraints and terms that you'll want to understand. And we are looking to the banks to underwrite those. We don't have a big underwriting department that does it, and then they'd underwrite it and effectively sell off 85 to 95% of that for us to hold. And so I think that your loan, your banker is probably the place to start as you try to weave through those various programs.
All right. We're guessing on the next question. I think this might be Cynthia Forbes. Thank you, Mr. Barkin. What impacts have you seen this crisis have on the higher education sector?
Well, I think the impact on the higher education sector is very much to come. I speak as the father of a sophomore in college who has certainly enjoyed the academic side of college, living with her parents for the last 2 months without enjoying the social side. But I think there are real challenges to the model that colleges have built over the last several decades. There's a question of if we don't have a treatment or a vaccine, can you operate in the way that you've operated? Can you bring thousands of students together into an environment where, I hate to inform everyone, they're really not social distancing, and with all the infection risks that implies. By the way, if you can't do that, how can you have college football and other things that many of us enjoy? If the answer is that, I'm really not going to do that, I'm going to do everything online, I think they have learned that they can do that online. Well, there are probably a set of institutions where people will continue to pay the money that they used to pay and, get the accredited degree. But if, you're a degree program where a lot of the people were going to be on campus because they wanted to be on campus, as opposed to, they were particularly fond of your teaching program, I think that will put a lot of those universities at risk. And we were already in a situation where smaller universities, less well-known universities were at risk. So again, to me, it depends a little bit on how fundamental the virus changes life. But if it does change life fundamentally, I think there will be a lot of universities at risk.
Okay, this next question is from Melissa McGuire. Hello, Tom. Thank you for speaking with us today. The PPP is a large program incentivizing employers to retain and rehire. Do you anticipate the unemployment rate rising again when that program ends?
I am nervous about how this plays out. As I might have said earlier, I think the legislation was passed at a time where the predominant view was still that this was a short-term shutdown with a V-shaped recovery. And so, if you will, we were building a bridge over that river to the other side, and people would, perhaps instead of reducing their workforce, would keep their workforce on for 8 weeks, and the PPP would pay the money for that. If you buy what I'm saying, which is that it's going to take longer and it's going to be slower, then the bridge doesn't quite get there. And so I've spent a lot of time recently talking to employers about how they're thinking about it. And of course, legislators are certainly considering what they should do about it. I could easily imagine a scenario where the PPP gets extended And so what I'm saying is, not relevant, but legislation is difficult to get done. And I don't think businesses are telling me they're counting on that. And so they're trying to examine what they do. Most of them, you'll be interested, they're not bringing back more than they can use today for the most part. They're very nervous about it, even understanding that means less will get forgiven. And so I don't hear a lot of employers bringing back employees so they can get the loan forgiven and then saying they're going to fire them, 4 or 5 weeks from now. Some of that I'm sure would happen if it weren't extended. But I hear people modulating their hiring, hoping that it comes back, and frankly, hoping that that they can get through this without having to have a second wave. But that's clearly a risk.
Okay, this is Caroline Hudson with the Charlotte Business Journal. Say a small business opted out of PPP or was not approved for some reason. What else can they do right now to navigate the downturn?
Well, I mean, obviously it depends a lot on what business you're in, but I think there's a operating side of it, which is how do you manage your cost base to match your revenue base, which has two elements to it. One is managing costs, but the second is exploring the question of whether you can't develop alternative revenues. That's the operating side of it. And then critically, there's a cash flow side of it. And it is, given what you think you can do on the operating side of the house, how do you manage your cash so that you can, live to fight another day?
Tom, let me elaborate on that one a little bit more. Do you see a role for local governments or philanthropy or even the private sector to help in helping these smaller businesses pivot?
Well, I do think, part of the spirit of the PPP, I think, shows strong bipartisan congressional support for even small to medium businesses and helping them survive. There's so much that they bring to our economy, particularly in terms of job creation and innovation. I think it is a really, if you believe as I do in how capitalism works, it's actually really hard then to get into allocation of capital, either through, government or at some point, you don't want to lose the importance of the business and figuring out how to pivot and where they are. And so that's a very, the answer is it would absolutely help. But the rest of the answer is, if we're in a world 3 or 4 months from now where we don't have a treatment, we don't have a vaccine, and people are scared to go to restaurants, let's just say, then it's going to be hard for any amount of support to keep restaurants functioning without a pivot. So it is a hard question, Janet. And I think the legislature is trying hard to support these businesses, but I do think we've got to bring commerce back. We've got to bring physical commerce back. And if we don't do that, no amount of money is going to help us.
Yeah. Continuing to build on this theme, thanks for speaking with us, Mr. Barkin. This is Katie Peralta with the Charlotte Agenda. What would you say local elected officials and business leaders can do to help bolster consumer confidence as our economy starts opening back up?
So go back to what I said about my family, who has been locked in our house for 8 weeks. We watch the news, we read a lot. Our limitation, and I'm not saying I'm representative of everybody, isn't having the money to spend. It's the question of whether going out and shopping is going to put my family at risk, or put my mother at risk if I see her, next weekend. And that's a very scary concept. And I really do think the public health side of this has huge potential stimulative effect. I would love to get clarity from the public health officials about, their level of confidence in my ability to interact in personal commerce without putting myself, my family, or my friends or colleagues at risk. And I think the stronger that can be said and the clearer it can be said, it almost doesn't matter how restrictive it is. In other words, we'll find a way around restrictions, but if it could be clear, right, and compelling, and based on science and law, not don't make something up, have it be real. I think that would be unbelievably powerful. And the more people who spoke in unison on that, the better. I'm struck by 6 feet social distancing. I guess that's the rule. When I woke up the 1st of March, I didn't know that was the rule. Somebody decided it was the rule, and now we can do it. And then a bunch of businesses can go, all right, 6 feet, I got it. 7 feet's great, 5's no good, got it, I can go. So the more we can do and the more specific and compelling that can be, then I think the more you're going to get people confident doing things again.
Great. Another question from Blaine. Are there particular economies or sectors in the Charlotte region who are in a better position to recover more rapidly?
Well, I mean, Charlotte is a great market and a great economy, and I think Charlotte is very well positioned for this. First, I started with saying, and it's true, that the banking industry, unlike last time, is in very solid shape. And so, not just the biggest banks, of which you have 2 now, but a lot of the medium and smaller banks and other fintechs and financial institutions around it. I think that happens to be a very strong industry this time, which hopefully will be maintained. Second thing I'd say is there's a wealth of businesses in Charlotte that are there because Charlotte offers a compelling combination of the advantages of a big city, but also the advantages of a somewhat smaller town. And if you believe, as I believe, that people in the densest urban environments are going to have to rethink a little bit the assumptions they made. My brother lives in New York City. He also has not been outside for 8 weeks, but he's in a much smaller place. I just think you're going to see a lot more migration. You saw some of it after 9/11. Charlotte's been an unbelievably powerful competitor in the world of corporate migration, if that's a phrase. So I would, I think that also works in Charlotte's favor. And then maybe this is more of a North Carolina point than just a Charlotte point, but I'm not one of those people who thinks you're going to see the whole world leave global manufacturing and everything's going to repopulate back in the US tomorrow. But if your supply chain is undiverse right now, if it's just in one country, that's probably not a place you're going to be 3 years from now. That's true for China, but that'd be also true for almost any country in a world where I think global risks are now clearer today than they were 2 years ago. And so I think there will be some amount of reshoring. And I think, if you will, the manufacturing communities in the outskirts of Charlotte, I think they'll do well too. So yeah, I feel very bullish on Charlotte.
We're going to edit that clip and put that on our website. That's a great
testimonial. You taught me well, perhaps.
Yeah, thank you. Okay, another question here from Lawrence. A secondary question building on Vinay's question. We are hearing that in a few months, lenders will begin the foreclosure process on businesses that are still shut down. If that's the case, would the Fed consider supporting a foreclosure moratorium similar to what the executive branch has done for homeowners, for example, Fannie and Freddie backed home loan moratorium? If not, are there measures that can be taken to protect businesses from predatory lenders taking advantage of a government-forced shutdown?
Well, it's not really our role to engage in the foreclosure process, so I don't have anything to say about that. That very, as you suggested in the question, that's an executive or legislative issue. I will say that as best as I can tell, there's been an unprecedented amount of forbearance in terms of rents by both landlords and banks, in terms of mortgages, in terms of credit cards and other debt. I think the answer here is probably not to over speculate on 3 months from now, but to focus everything we can on getting the circumstances right for the economy to recover so that we can avoid that kind of outcome.
Okay, going to some of our questions that were sent in advance to us here. With the national debt going from about 100% of GDP to 120% or even higher, what's the risk of hyperinflation and instability of the US dollar as a global backbone?
So I think it's very hard to see hyperinflation on the horizon. And I mean, the CPI was announced today and inflation was negative, not positive. and God forbid if we did have inflation come, I do think the Fed has proven we have tools which can handle that. So I don't worry about debt from an inflation standpoint so much. I do think that our ability to carry debt is very much based on the goodwill of the people who lend us money, and many of whom are Americans, some of whom are not. The 10-year, when I woke up this morning, was at 71 basis points. That's the mark of a world that believes that the U.S. debt is the safest rule of law, highly liquid, instrument in the world. There is a quote I like out of The Sun Also Rises, where someone asked one of the characters in Hemingway's book, how do you go bankrupt? And the guy says, gradually and then suddenly. And I think that's the risk for us. I don't think there's any pressure right now at 100% of GDP or 120% of GDP. But there is some point out there in the horizon where people will decide they don't like our debt anymore. And if and when that happens, you'll see rates, especially long rates, spike. And of course, that's very constraining for an economy. And so that's, I think, the risk that's out there. None of that says to me we shouldn't be investing right now in making a bridge to the other side. I think that is the role of the fiscal authorities. And this is a huge, check mark, and we can do something to get to the other side of it. But we're certainly going to have to think about what combination of, faster growth, less spending, higher taxes makes sense going forward, or we run the risk of becoming like that Hemingway character.
Okay, this next question comes from Joaquin. Mr. Barkin, can you please elaborate on the risks of buyers spending less and saving more?
Well, it sounds weird to call that a risk, since that's one of my personal philosophies. But when you add it up across the entire economy, if we have 2/3 of our economy being consumer spending, then if what you've got is consumers spending less, you have less growth in the economy. By the way, we saw a lot of that coming out of the last downturn. People deleveraged. We had very high leverage the last time. People paid it down, and you see, debt to wealth or whatever go down after that downturn, and that's probably part of what modulated our recovery in the early parts after the Great Recession. On the positive side, if more people saved, you'd have more money to invest, and maybe that would have businesses invest. So I think over the medium term, that might be fine, but over the short term, you'd take a hit.
Okay, another question here from C. Hudson. Banks have implemented deferrals, cut fees, reassessed credit risk, etc. At what point are those no longer viable options for the banks, and how will the Fed advise the banks as or if the pandemic drags on?
Well, I think this is the tricky question that I was talking about earlier, which is the banks are in a position in this crisis, unlike the last crisis, to lean forward and help people in need. And I'm encouraged that they're doing that. At the same time, it's in everybody's interest, including the banks, and certainly including the Fed, which is an agency which regulates the banks, to have the banks be safe and sound. And so, I think the longer this happens, the longer this goes on, the harder it is for the banks to continue to be leaning forward. So I think there is a real interest, and certainly I have this interest in seeing if we can't get things to come back faster rather than slower, which takes the pressure off this particular issue.
All right, another question here from David. Thank you for your time and clarity today. Do you think there's significant cooperation among the world's central banks addressing these problems, or is that less than optimal?
So I think the group of central bankers around the world do, in fact, meet and talk quite frequently. And I do think share best practices broadly. In fact, many of the things we did in the last downturn had been experimented with, tried in other places. And we do our conferences, which I guess we're probably not going to be doing much going forward. You often hear from people in other central banks what they've done. And we learn lessons, both good and bad, from other places. We're also cooperating with the major developed country central banks on some swap lines that I didn't mention earlier, which basically make it easier for them to get dollar funding in partnership with us. And so I think there's a large amount of cooperation. I'll just say, though, our mandate is the U.S. economy. It's not the European economy or the Chinese economy, it's the US economy. And so we take our own decisions, informed as best we can, but on what we think is best for the US economy.
Great. Okay, a little bit of a different direction here. Some have speculated that there will be a short-term move away from density. If that's true, how can rural and micropolitan areas benefit from this potential trend?
I think it's a really interesting thought. Again, I always caution, we may have a treatment or a vaccine in some point in the future, and we may forget all about this the way we kind of forgot about air travel being unsafe and started flying again. And so I don't want to create some big grand vision of the future that, you know, might get dropped, but I have to say I'd have a hard time figuring out how to take the subway to go to work in an infection environment, and I bet a lot of people will. And so if you believe this thing will continue, then I think you will see people wanting to go to places, more open spaces, perhaps more an automobile to get to work, perhaps more work from home. That could start to reverse a trend which has been, you know, a couple decades in length of people moving more and more to the bigger cities. And there's a lot to say for a smaller town in that environment. Now, I think if that's where you would like things to head, and I would in part, I think you got to think about how do we equip the smaller town to be an attractive destination. So topics like broadband. I mean, there are kids in my daughter's school who went home and couldn't do the schoolwork because they couldn't have access to online. Okay, so if you don't have that, then you're probably not going to have people going at scale into those markets. Healthcare. Right now, I think I mentioned earlier, rural hospitals are challenged greatly. Now, you know, maybe you design a world where telehealth allows you to build out a healthcare network, leveraging broadband that's much more broad, much more sophisticated, and can really work in those smaller places. Great. If you can't, that's kind of hard. Amenities, and you know, so there's a set of things of food. There's a set of things that would have to get provided, but there's a virtuous circle when these things happen. It's not impossible to do it, and you know, broadband is a classic example. We're doing some research about how to really get this done at scale, because I believe not enough money, even the money people talk about, is nowhere near what needs to get done. But if you could do some of those things, I think you could equip some of those cities to receive those folks. And I think that would be very interesting.
Mm-hmm. Just kind of piggybacking on that thought, are you hearing or seeing any inklings of maybe what were more nascent industries now having to accelerate because of the disruption to these more major things around transportation and travel and food service and supply? Are you hearing or seeing anything like that?
Well, of course, you see the obvious stuff. If you've gone to a grocery store lately, you'll see a bunch of Instacart people who are in your way and don't look like they've been to a grocery store before. You know, your online commerce has expanded, your telehealth has expanded. I think another really interesting sector to talk about is home health. You know, my mother's not well, but when my siblings and I have a conversation about, you know, whether a nursing home is a good idea, we quickly decide that's not probably the right time to do it.
Right.
And so what are alternative healthcare measures for folks? I don't know, but I think that's a whole industry that could well be, you know, redesigned. Again, if you think in any way, shape, or form that this virus will be with us for a while, a lot of these personal contact industries, you start to think, okay, how could this thing operate in a way that it was seamless and it really worked? And if it, you know, telehealth is a great, all these things I think are out there for people to pursue. I should say one of my big beliefs on just the economy is uncertainty is a real barrier to business investment and even consumer investment. And at levels of heightened uncertainty, it's really hard to take the plunge. And so obviously this is heightened uncertainty. We don't even know if we can engage in commerce without infecting our family. But it goes back to why I was so interested in creating some health certainty, because if you could, I think it would unleash a lot of this stuff. On the other hand, I find myself saying, gosh, maybe I should invest in a home health thing. Well, wait a second. What if we have a vaccine in 3 months? That push-pull is very hard. So I do think clarity and certainty would help a ton.
I'm sorry to hear about your mom, and I hope that she's on the mend and getting well soon.
Thank you for saying.
Yeah, we probably have time for a couple more questions, Tom. So I'm going to go to one that's interesting here. You might not get one of these before. How's your previous career experience prepared you for these unprecedented times we're now in with the coronavirus?
Yeah, well, thanks for asking that. So I was a consultant at McKinsey for 30 years. I also ran the Southern offices during 9/11, and I was CFO of the firm during 08 and 09. And so the first thing I'd say is, sadly, I've been to this rodeo before, and that's I guess that's good to have experience. It probably comes with less hair, but I'm able to see that there's another side to it. I'm able to remember the concern that we had about whether our bank accounts were safe in 08, the concern that we had about whether we'd ever fly again in 01. And I think it gives me at least enough perspective to imagine that there's life on the other side. Also enough perspective to not overreact, as per some of the conversations we're having. Second thing is I spent a lot of my time trying to understand how businesses operated. And so I'd like to think that I can bring to the FOMC a different kind of vision of what happens. And we have a very talented group there. A significant majority are PhD economists. And so, if you take expanded unemployment insurance, for example, as a topic where every business person you talk to says immediately, well, I can't hire anybody. And the economists, I'm not picking on anyone in particular, but a classic, might say, well, yeah, if you can make more money here than you make there, well, and I'd like to think I can ask 3 follow-up questions, understanding how businesses operate, in fact, that might distinguish between, for example, will people quit a job to take enhanced benefits versus will they leave enhanced benefits to take a job? Those are 2 very different pushes, I think, with very different outcomes. And so I just think having a little bit of experience sitting in a chair, having to think about revenue, sadly, at times having had to reduce costs, might give me perspectives on where things are going that are different and maybe better.
It's always nice to get the personal perspective of that. So thank you for sharing that. So taking a step back then, wearing your Fed Reserve hat, how do you see the Richmond Fed Reserve emerging from this crisis relative to the other Federal Reserve regions? And how will the Federal Reserve respond to the second wave of COVID-19 if it does come in the fall?
Well, one of the things I've been pushing our bank
I think we might have a frozen Tom. I can see movement on some other screens. So just bear with us, folks, as we see if we can get him back online. Tom, if you can hear me, we lost you. All right. Well, if he doesn't come back momentarily, folks, I will see. Kathleen, if you or Katie could just on the back end check in with him. Oh, I think he realized he did. I think he left, and perhaps he'll come back here for closing remarks. All right, well, if he ran into problems, I can see folks starting to say goodbye. I do just want to thank everyone again for joining us today. I thought your questions were on point. I thought Tom's perspectives were always, again, really insightful. We've enjoyed having him participate with us on previous discussions. We actually hope that we can bring him back. Oh, there you are, Tom. You rejoined us. Let's unmute you. You're still on mute. Let's see, Katie or Kathleen, could you help out by master unmuting him? There we go. All right. Do you need a repeat of the question, or are you still good? Oh, still muted some way for some reason. Still muted, Tom. All right. We are having some technical difficulties.
Okay, I think you can hear me now.
Perfect. Gotcha.
So you asked, how's the Richmond Fed going to evolve? And I think we're just going to improve our IT systems.
That's a good start.
So I apologize for that.
Okay.
Look,
All right. We've frozen you again. All right. I can hear you wrestling in the back there, Tom. Are you with us again? Okay. Well, folks, I think we'll probably wrap then just a few minutes early. I do want to thank you again, and hopefully we'll bring Tom back maybe towards the end of this year. Hopefully it'll be in person where we can see everybody's faces. Tom, do you want to try it one more time? Or are you done?
I'm sorry about that. Much more available in the communities, and we've just tripled down on that, which is why you see these webinars, which is why you see us publishing every week a bunch of stuff going on. And I think there's a real opportunity for us to be in a district that goes from South Carolina through Maryland and West Virginia to be an insider in each and every market. That's really my aspiration and hope. In terms of what we do going forward, I think the most important thing is to avoid a second wave. If we do have one, there is still a lot of balance sheet capacity available at the Fed. There's still a lot of lending capacity from the CARES Act. And, we'll just have to think about what the situation is at that time. I'm a big believer that you do horses for courses. You invest in whatever it takes to fulfill the mandate. And so we'll see what the situation is then.
That's great. Well, thank you, Tom, for your time, making yourself available to our group today. And as I was mentioning, I hope that we can bring you back. And next time, I hope it can be in person, maybe with limited capacity, but still, we always enjoy having you with us. And please stay safe. Get some time outside of your library today.
Thanks, Janet. Great being with you, and apologize for the technical things there. I'm so sorry.
No worries at all. And I just want to also thank our regional economic development sponsors, American Airlines, Novant Health, and Lincoln Harris, Northeastern University. We appreciate all that you're doing for us, Perkins and Will. And that might round out our program. Thanks, everybody. Please stay safe out there.